Welcome to The Explainer. I am absolutely thrilled you're here today because, well, we're embarking on a journey through a truly game-changing financial mechanism. Let's dive into the exact rules, the critical dates, and of course those hidden pitfalls right from the official guidelines as we completely master the life cycle of a CGTMSE guaranteed loan. Whether you're a lender trying to navigate the compliance maze or just a business enthusiast wanting to understand how credit actually flows to those who need it most, this explainer is built specifically for you. Okay, let's jump right in. So, you need a business loan, but you lack collateral. It's the absolute classic catch-22 of the entrepreneurial world, isn't it? You need money to build your assets, but banks, well, they want assets before they give you money. This single question highlights a massive problem that has literally plagued millions of small business owners. But what if there was a safety net that allowed banks to confidently say yes without asking you to put your house on the line? Enter the Credit Guarantee Fund Trust for Micro and Small Enterprises, or as we'll call it, the CGTMSE. This scheme is essentially designed to prioritize project viability over traditional collateral. It secures the credit facility purely on the primary security of the assets actually being financed. In simple terms, it totally eliminates the need for third-party collateral. It acts as a massive safety net for member lending institutions, the MLIs or the banks, taking on the risk so they can actually fund new and existing micro and small enterprises. So just how big is the safety net? Well, the magic number is rupees 2 crore. That is the absolute maximum credit cap per borrower eligible under the scheme for micro and small enterprises in both the manufacturing and service sectors. Now, there is one key exception to note from the guidelines. If you're in retail trade, that cap is adjusted down to rupees 1 crore. But for most MSCs out there, 2 crores is your ceiling for both fund and non-fund-based facilities. You know, things like term loans, working capital, and letters of credit. Here's our quick roadmap for today. We'll cover what the CGTMSE is, the rules of eligibility, the extent of the guarantee cover, calculating annual guarantee fees, deadlines and data collection, and finally, managing NPAs and claims. All right, let's kick things off with sections 1 and 2. What exactly is the CGTMSE, and what are the baseline rules of eligibility? There are two major eligibility rules that really stand out here. First, if a bank is extending a credit facility above rupees 50 lakhs, it absolutely must be internally rated to determine investment grade. They can't just rubber stamp it, right? Second, the scheme recently introduced this really fascinating hybrid security model. This actually allows for partial collateral security. Essentially, a bank can take collateral for part of the loan and then use the CGTMSE guarantee for the rest, up to that 200 lakh limit we talked about. The CGTMSE will then have a pari passu, or basically an equal charge, on both the primary security and the borrower's collateral. Now, the scheme strictly defines primary security in two distinct tiers. Tier 1 refers to the brand new assets created directly out of the credit facility you just received. Tier 2, on the other hand, refers to existing unencumbered assets, like, say, a factory godown, that are directly associated with the business. Why does this matter so much? Because the rules explicitly state that a charge on those Tier 1 assets, the ones you actually acquired out of the sanctioned loan, is strictly necessary for invoking the guarantee later on. Basically, you have to secure what you buy. Moving right along to Section 3, let's look at the extent of the guarantee cover. So, coverage density isn't just some flat rate across the board. It's actually a tiered system specifically designed to incentivize lending to vulnerable or priority sectors. Notice that microenterprises taking small loans up to 5 lakhs, they get a massive 85% coverage. Women entrepreneurs and units up in the Northeast region, they get a solid 80% coverage. Standard borrowers get a really healthy 75% safety net. However, you'll see retail traders only receive 50% coverage up to a maximum of 50 lakhs. This right here is essentially the ultimate cheat sheet for lenders trying to calculate their actual risk exposure. Okay, shifting gears into Section 4, calculating annual guarantee fees. Let's look at the maintenance phase. Fee calculation changes completely based on your loan type, and this is super interesting. If it's a term loan, the fee is calculated on the exact outstanding amount as of December 31st. Lenders literally have to upload the principal repayments to arrive at this exact figure. But if it's working capital, the fee is calculated on the maximum or peak working capital limit the borrower actually used during the previous calendar year. It's a critical distinction that completely changes the math for the lender. Next up, Section 5, deadlines and data collection. Timing is absolutely everything here. Member lending institutions have to follow a very strict chronological timeline every single year. By January 15th, All that data we just talked about regarding outstanding amounts and peak limits must be fed directly into the CGTMSE portal. And listen, if you miss this January 15th window, the rules state the fee will be calculated on the full original guarantee amount. That means paying significantly more than you actually need to. Then, in the second week of February, the demand for the fee is officially generated. And finally, by April 15th, the AGGF must be paid in full by the lenders. But what actually happens if a lender drops the ball and just doesn't pay the annual guarantee fee? Well, the account gets closed. Boom. Done. And if you realize the mistake and want it revived, you better prepare for a shock. You're going to face an additional risk premium of 15% charged on the standard rate. And the kicker? That is applied in addition to any existing pricing structure or penal interest. It is a heavy, heavy price to pay for missing your compliance dates. All right, let's enter the final and most critical phase. Section 6, Managing NPAs and Claims. The actual mechanism of lodging a claim is a pretty straightforward, secure two-step process on the portal. Step 1 involves an MLI maker submitting the claim. Step 2 requires a separate MLI checker to review and approve it. It's just your standard internal control. But as any seasoned banker will quickly tell you, hitting that submit button is really only half the battle. The real challenge is making sure your claim doesn't get outright rejected.
So consider this your absolutely critical survival checklist. Claims are immediately rejected if that annual guarantee fee wasn't paid on time. They're rejected if the bank took legal action against the borrower before officially declaring the account an NPA. If a loan over 50 lakhs wasn't internally rated, rejected. If the account turned NPA within just 3 months of getting the guarantee, that is a massive red flag, and yes, it will be rejected. Or if the bank secretly went ahead and obtained third-party collateral, which completely nullifies the whole purpose of the scheme. Avoiding these simple errors is absolutely paramount.
Timing for marking an NPA is extremely strictly regulated. If an account turns into a non-performing asset during a specific quarter, let's say, for example, between January 1st and March 31st, the action required is that the NPA particulars must be marked in the portal before the end of the subsequent quarter. So in this example, that means before June 30th. It is a hard, non-negotiable deadline for maintaining the validity of your eventual claim. And finally, we reach the end of the life cycle. Even after a claim is settled and the bank gets its money back, the relationship isn't quite over. Any subsequent recoveries the bank manages to make from the defaulting borrower must be passed right back to the CGTMSE. To properly close the loop, MLIs must submit a consolidated statutory auditor certificate by September 30th every single year, confirming that all recoveries as of March 31st have been properly handed over. It just ensures a perfectly clean financial slate for everyone involved. So as we wrap up this explainer, we've seen firsthand how the CGTMSE transforms lending from a rigid game of collateral into one of project viability and structured compliance. But it really begs a fascinating final question, doesn't it? If these strict structural guardrails can completely eliminate the need for traditional collateral here, what other massive financial barriers could we dismantle with just a little bit of well-designed structured guarantee? Think about that for a while. Thank you so much for joining me on this explainer, and keep learning.